In order to maintain reward to risk in a trade, you've got to have multiple ways that you're going to exit this trade. A lot of traders will just have a profit target, a stop loss, and that's it. It's either going to be one or the other. But that doesn't really maintain the reward to risk ratio at all, right? So let's say you bought XYZ stock at $100 and your profit target is 120, and if it falls to 90, that's where you're going to stop yourself out, right? So we're just talking about a 2-to-1 trade on this. Let's say it gets to 119 and it peters out, right? Like it just falls all the way back down, stops you out at 90. Now at 119, what was your reward to risk on this trade, right? You only had $1 left of potential profit that you were aiming to get on this thing, and you let it fall all the way back to break even, all the way down to your stop loss. You were risking, well, what is that? That's the $29 to make $1, right? Not a very good reward to risk at all. So in order to manage your reward to risk in the trade, you've got to raise your stops. You need to have some mechanism where you're going to start to take profits along the way. Now there's a lot of different ways that you can do this, right? The way that I like to do this is a couple of different ways. The first way is once I have certain multiples of my initial risk, then I'll start to take profits out along the way. So for using this example, at 110, I would have made 1 times my risk, and there would only be another 1 times my risk left in this trade, right? Like, so I had risked $10, and I had made $10, and there's another $10 left. Great. So in order to manage my risk in this, I would take a little bit of the trade off, bank some of that money, and then I would start to raise my stop, right? Because if I allow the trade to just fall all the way down, then to my original stop loss, I would be risking $20 to make 10. It doesn't make sense anymore, right? So I take a little bit off and I raise my stop, and I'm most likely raising my stop to somewhere in the neighborhood of break even. That way, I would just be risking the $10 of profit or whatever was left that I didn't take off already to get to the larger profit target. So so that's one way that I'm managing it. Another way, I like to use moving averages. It's one of my favorite tools to use as a technical trader. The reason why is because it's just showing you the momentum of price. If it's holding above a certain moving average, then it's telling you that the momentum is strong for that particular period. If it's falling below that moving average, then it's telling you that momentum is starting to shift in the other direction. Maybe it's time to start scaling out a little bit, and that's what I'll do as well. Then the other way that I'm managing my risk on this trade is to set the backstops, right? So let's say price moves up, starts to consolidate, runs up again, great. It built a floor. I'm placing my stop below that floor because in case it falls through the floor, I don't want to be in that trade, or at least not the entire trade anymore, so I'll start to scale out of it again that way. So I'm giving myself multiple ways out of this trade. I think of it as multiple ways for the market to pay me, right? A lot of traders want to try to let the trade run for as long as possible, and there's a lot of wisdom in that, right? Like cut your losers short, let your winners run. Fantastic. But we also want to figure out ways for the market to pay us, and how long do we let it run? Do we let it just run up to infinity, or do we let it run all the way back down to where we bought it, right? Like, well, we need ways to allow the market to pay us. So long as the trade is working in my favor, I will let it continue to run. When the trade is no longer working in my favor, I want to start scaling bits and pieces out. And that's where those moving averages come in. That's where the backstops come in. And that is how you can maintain your reward to risk throughout the life of the trade.